Today's episode of The Compound and Friends is brought to you by our friends at Crane Shares. They have a webinar on Wednesday, March 29th. There is CE credits available. Roger Mortimer, great name, who is a portfolio manager, is going to be speaking with Luke Oliver, who I've had on Animal Spirits. He is the head of climate investments. The webinar is about this. Josh, tell me if you got any thoughts.
Go.
From high emitting to high growth, opportunities from companies transitioning to renewable technologies.
I'm in. When is it? When is it?
It's Wednesday, March 29th, 2023 at 11 a.m. What's EDT?
I don't know. That's Crane Shares.
Eastern Daylight Time. Crane Shares with a K.
The K is for quality.
Craneshares.com to learn more.
Oh, wow. Look at this. Episode number 84, the St. Patrick's Day episode. And as is customary, we have our favorite St. Patrick's Day guest with us today. You might know him on social media as Super Mugatu. His real name is Dan McMurtrie. Ladies and gentlemen, Dan McMurtrie.
Dan, I actually quoted the real Mugatu yesterday. Like the Play-Doh, molded like Play-Doh.
Yeah.
Any type of dough.
Yeah. Yeah.
All right. Dan is the co-founder and CIO of Tyro Partners. It's a hedge fund that invests in the tech, healthcare, industrial, and consumer sectors, as well as a fan favorite TCAF guest. Welcome back to the show. Do you get get any feedback when you appear on the show? People excited to hear from you?
Occasionally, I mean, we always get
occasionally, guys.
we always get some nasty comments, but 95% are people just being like, "Oh, this is great," and we always get good responses to the
What's the
outfits.
nasty comments? Hey, you have a career and I don't.
Yeah, generally, more or less.
Yeah.
Or something like that.
You could read between the lines.
Yeah.
Can you imagine being mad at somebody who went on a podcast?
I have just too much stuff to do. I don't know how people have time to be angry at people they don't know.
Oh,
I have enough people I know who I'm upset with.
Oh, they have plenty of time.
That's a good point.
They have plenty of time. That's the problem. All right. First things first. Everything's basically good now. Is that what we're saying?
Not really.
Credit Suisse is saved.
Well, all right. Let's write in.
No, write in.
Write in.
This
all
is
right.
the thing that happened just now.
Chart on. So you could look at this chart of credit default swaps for Credit Suisse blowing out and say, holy shit, we're all going to die. I don't know who the chart came from. I apologize. There's no credit here to be given. Or you could say, well, actually, credit default swaps at other European banks, UBS, Deutsche Bank, SocGen, BNP, not exactly the healthiest banks, are not doing anything. There is no contagion outside of Credit Suisse. It is a shit bank. It was a shit bank. Probably will always be a shit bank.
It was a $2 stock last week. It's not new. Nobody's blown out of the right. Nobody's. Can we just a definition for people that don't manage global macro hedge funds or are not financial journalists and don't really understand what CDS is? In layman's terms, basically, these are people buying insurance against
the solvency of the bank.
Solvency, the default risk, whatever, of an institution. And this is where you would look if you're looking for real stress.
So it's just put options on steroids. If you were bearish on Credit Suisse, you buy credit default swaps and now you just got paid.
Yeah, I mean, these are a lot more tricky than put options, which are also
These are not retail.
No.
This is International Bank of Settlement stuff. You have to...
Duncan puts the shit on.
Yeah, this is only Duncan level trading and higher.
Right. Yes.
Okay. So who is buying CDS on Credit Suisse? Is it mostly their counterparties in the banking world or hedge funds speculating? Who else is in this marketplace?
It's Bill Wang.
I mean, it's mostly sophisticated. It's going to be banks. It's going to be a certain type of hedge fund. But I think one of the things, and this is similar with put options, once they get over a certain level of expensive, they don't offer you a crazy nonlinear payoff. And so they become a lot less interesting to most people. And then you end up with a very specialized market. There are people sometimes who have to buy these things because they have to have insurance against maybe a counterparty or something like that. But the issue is if you have to pay some crazy amount to insure your counterparty, you're probably just going to stop trading with them.
That's right. That's a better insurance plan.
Yeah.
Unwind and ignore.
Right.
So Credit Suisse is what's called the GSIB, a globally systemic important. Did I get that right? GSIB.
Globally systemically important bank.
Sounded weird coming out of my mouth.
Right.
But how many are there? I think there's 20 of them.
I mean, this is obviously one.
This is one of them. So here are the numbers. This is from Felix Simon. Credit Suisse had total assets of $574 billion at the end of 2022, down 37% from $912 billion at the end of 2020. Its asset management arm supervises another $1.7 trillion. Last night, its largest shareholder, the Saudi National Bank, said they can't provide any more capital because of they can't own more than 10% of a bank, and the government stepped in.
So that's what triggered like this race to buy CDS, is that the Saudis and I guess other sovereign wealth funds were like keeping this thing afloat. Is that your understanding of it?
I'm not sure. I mean, I think one of the key points of distinction that maybe is missed in like the Twitter discourse or some of the media is that there is a significant difference between a bank continuing to operate under a certain name and there being any payout for the equity, the preferred shareholders, the bond holders, things like that.
Right.
And so there are real scenarios where, from a customer's perspective, there's not that much disruption in a lot of these firms, but a lot of other people get impaired. And then you have a bunch of weird regulatory issues here where, you can't own over a certain percent. JP Morgan isn't going to be allowed to just buy every other bank. There's all sorts of weird pressure points here.
Why did the Saudis feel the need to put that out there, that we can't buy anymore? Did anyone was this in response to somebody being like, are you going to buy more Credit Suisse?
Probably.
I don't
Actually,
know.
this
I don't
is
know
genius.
anything
Maybe
about
they're
that.
like, we're out, and the government, it's on you. And so it probably worked. Maybe that was it.
This was a good moment to rip the Band-Aid off, I guess.
You never know if there was a reason or no reason.
Okay. Credit Suisse had total assets of $574 billion
I just did that.
at the end of 2022, down 37% from $912 billion at the end of 2020.
I still just did that.
Asset management arm supervises another $1.7 trillion in assets.
Did that one as well.
Very good. Well done. All right. So I'm just trying to understand now. They got $54 billion line of credit, effectively, from the Bank of Switzerland, which is basically the government. And they had $200-something billion on deposit or something. So it's like they have access to the equivalent of 25% of their deposit base if, in fact, they need to draw on it, which probably eliminates the need for them to have to draw on it because maybe whatever deposit or exodus they were worried about. What do we got here?
Deposits plunge. I mean, this is really something. Look at this. Holy
Does
moly.
it? Yeah.
Oof. And it's obviously worse now. This is
$400 billion to $250 billion.
Yeah, it's bad. Here's a great lead from Bloomberg. They said Credit Suisse's failings have included a criminal conviction for allowing drug dealers to launder money in Bulgaria. It was cocaine, by the way. Entanglement in a Mozambique corruption case. A spying scandal involving a former employee and an executive in a massive leak of client data to the media. Its willingness to engage with clients that some other banks avoided, such as disgraced financier Lex Greensill and failed New York-based investment firm Archegos Capital Management. Lost at billions of dollars and compounded the sense of an institution that didn't have a firm grip on its affairs.
So it's so global that they were like involved with crimes on every continent. It's really, I mean, it's highly impressive. Like if you say nothing else, it's very impressive. There was an article 6 months ago about a guy they hired whose job it was to run around the world and settle all these court, like just bury this stuff, get rid of it.
Was it Ray Donovan?
It was not, but it's like a similar type of story. And I guess this stuff caught up to it before they had a chance to do that.
So when you go like Monday morning or Sunday night, you're thinking about, all right, how is this going to impact my portfolio? Mm-hmm. Where's your head going?
We don't really do a lot of financials, but I think that the big issue and the big question right now is really, is this going to have a domino effect where it affects credit availability for the rest of the economy? And as long as it stays isolated to an individual bank, that bank's shareholders, that bank's bondholders, there's not that much risk. There isn't that much cross leverage and cross default issues that you had in 2008. It's a very different situation. It's a little bit more like savings and loan. But the big high level problem right now is you just had the Fed raise interest rates, right, in the last year. Now, people are talking about deposits, but not all deposits are the same. So if you have a checking account, you're getting like nothing on that, right?
Right.
But if you have a savings account or a money market account, which you would, a normal person would think is a deposit, well, you might be getting 4 or 5% on that right now. And a lot of money was sitting in checking type accounts where the bank didn't have to pay anything to have that cash. And what has started here is because there's some general anxiety, a lot of people are just logging into their account and going, I think my bank's fine, but you know what? I'm just going to move over to the money market.
Yeah.
And now the issue is when we're talking about deposits in terms of what it means to the bank, that's not entirely the same as you pulling your money out of the bank, but it's a lot closer to that than you'd think because all of a sudden they're having to pay 4 or 5%.
Just to keep the deposits
Just to
on
keep
hand.
the deposits.
Yeah.
And okay, if they want to go buy long bonds, they're not getting 5%, right? And so if you look at a lot of banks right now, you look at basically what they were paying for the deposits last year versus what they were getting on all these assets they own. And they were getting, depending on the bank, loans, bonds, all that, less losses. They're getting like 2.5%, maybe 3%, right? And they were paying 0.8%.
Yeah.
So all of a sudden, as this is happening across the board, banks' costs are going from 0.8, 1%, somewhere down there, to the incremental dollar is 4 or 5%. And if you're a bank that's in trouble, you have to offer something above that, because why is somebody going to take a risk when they can get 4 or 5% with no risk?
Right.
So the banks are kind of, in general, backwards right now on, it's the opposite of like how people think banks work. Like right now they are having to pay more than they're receiving to buy these assets, right?
And then earning less internally.
Right.
Yeah, this is the opposite of what the story was last year.
Right.
Like the end of last year, the story on financials was net interest margins will rise because intermediate term rates are going up, and
Right.
Funding is still cheap because there's so much money in the economy. People are keeping
But they did. But interest
huge
margins
balances.
Did rise. They did rise.
But the
It
curves,
kept going.
well, people talk about the curve, and that's like something that everybody uses, and that it's not explained a lot. But what we mean by that is that short-term deposits, short-term lending, short-term borrowing, your 6-month to 2-year T-bills,
Right.
that rate is much higher than long-term interest rates right now. And
But,
so
but that's also higher than what the banks are paying out. So they're still.
But
they're
that's
still raking.
because people were leaving their money in checking, right? And so the issue right now is that if you're at a bank and you're just like, okay, I haven't looked at my bank other than just checking my statements in a year. And all of a sudden you look and you go, I'm hearing scary things about banks. I don't know what's going on, and I'm only getting 1%. If you don't have to actually pull your money out of the bank to hurt the bank. If you just switch it into a different type of account where you're getting some yield,
They're making less.
So Bank of America.
they might be making negative.
Yeah.
Bank of America got $15 billion in deposits after SVB failed, and I imagine that JP Morgan is the same, if not more. Somebody tweeted, I can't remember who, like a badass move would be JP Morgan to take rates to zero.
There's a technology aspect to this story, though, there is no real corollary to 2008, in that it's never been easier and more casual to move money around.
Right.
And that's probably something that's going to have to be looked at. And of course, there are going to be hearings on this shit, and Senate Finance Committee and the regulators. They're all going to have to say, well, how do we make it so that a bank doesn't lose $40 billion in 24 hours?
Right.
Like, because that's a really big part of the story. This is not like, 20 years ago, if you really wanted to move money from one bank to another, you had to show up at the second bank, open a new account, then go back to the first bank, get a cashier, certified check or something,
Right.
Or you had to enact a wire. This is a whole new world where you can do that shit like from a bathtub.
Yep.
On your phone, and that is, I think, something that is going to be a bigger part of the story when they look back and say, how is it possible that a bank was healthy Monday and dead on Wednesday?
Crazy.
Right.
To me, the story this week inside the markets are the lack of panic in junk bonds. Junk bonds are ripping today. They'll probably finish up the week. You're not seeing any stress in senior loan or bank loans. You're not seeing any stress in investment grade. The VIX is barely moving.
Yep.
But where you are seeing a ton of volatility is in interest rates.
So is that a technical term?
We have a few charts. It is. We have a few charts on this. So this is the U.S. yield curve for the week. John, chart on, please. I mean, this is madness. Not something that you expect to see, right? Just like total insanity there. The market is now pricing in 100 basis points of rate cuts by September.
That's like overnight.
Like that
We went from, oh my God, they're going to do 50 to what if they don't do anything and start cutting?
So
That's a huge pivot.
So 3 weeks ago, after you got the PCE data, that's the orange line that we're looking at, you had Fed funds rate going out all over 5% for the rest of the year into January. That's what the market was pricing in. And then boom, you got this panic over the weekend, and there we go. That's the bottom two lines. Just
since
collapse.
March 15th, expectations for 5% interest rates
Gone.
just completely gone.
So this is the conversation. Maybe this is why stocks are ripping, is because people are saying, okay, the panic will cause the Fed to chill out a little bit. Although there's still a 50-50 chance of 25 or pause.
Do you look at your holdings or your allocation in through the lens of how interest rate sensitive is my portfolio?
Yes.
Okay, but that also then can create opportunities
Yeah.
on the long and the short side also.
Right.
So how do you think about that? Or how do you gauge that?
Yeah, I mean, when you're looking at bonds, people talk about duration. Are you owning like short-term bonds, medium-term, long-term? There's a similar dynamic with equities. You know, if you own a growth company, the idea is they're going to pay you back a long way in the future. Now, the problem is if you can earn 5% every year between now and the future becomes less interesting,
That's
more
right.
or less. And that's just, a discounted cash flow, basically. But if you have a business that's throwing off a lot of cash that's not really exposed to the economy, as the valuation comes down, you start to care less and less about what the interest rate is within reason. And then there are certain points, there's certain levels on everything where at the end of the day, if the world doesn't end, you're buying, right? And so kind of the first exercise we're doing on every company is like, okay, the smash glass, the market's down 30% tomorrow. What price do we buy kind of no matter what, assuming that the world is not magma, right? And then from there, we try to build into what do we need to be sure about in order to deploy risk capital here. And we do mostly things that are not super big weights in the index, things like that. So the stuff we do is it's not necessarily less liquid, but the liquidity is very variable. And so it can trade really, really crazy relative to S&P large cap stocks.
What, like big bid-ask spreads or more volatility?
Well, it's more like, if you're looking at stocks that are like 1 to 20 billion, which is generally what we tend to be investing in, you can have a month where on the average day it trades $25 or $30 million. And then you can have a week where on the average day it trades $700,000.
Yeah.
And like during that week, if you need to move in or out, good luck, because the price is going to go nuts if you try to move. I mean, people with Robinhood accounts can move these stocks on weeks like that. So right now, I mean, when we're looking at a lot of the things that we trade, that's happening. Liquidity is super low. So as we're looking at these price moves, it's hard to tell what's in them because really, really small. I don't think Wall Street's scared. I think Twitter's really scared. If you look at most of the headline indexes, they're up for the year. I'm not seeing that much actual fear from kind of big money participants because a lot of the type of risk we're dealing with right now has already been hedged out. But people are very anxious, and so there's not as much trading activity in a lot of the things that I look at. And so really, really small buys and sells, you're seeing, I mean, just look at like some of these stocks intraday. I mean, they open up down 60%, then they're up 50, and then, I mean, this is just an incredible amount of volatility.
Are there stocks that or stories where you would be short and then interest rates plunge the way they just have? And you say, you know what, this company might not be as challenged as I thought they would be a couple of weeks ago? Or is that too sensitive to recent price?
No. It depends. It depends what the type of company is. And also depends like why are interest rates being cut.
What if it's like a green wig manufacturer?
Yeah, for example.
Yeah, for example, theoretically a green wig manufacturer.
Shamrock Wigs.
If you're talking about a company that you think needs access to credit,
right,
and under normal circumstances can get access to credit, but credit is tightening, and all of a sudden, if they lose access, they might blow up.
Yeah.
Then you're 100% going to cover that short if interest rates start to ease. And there are things like that. Like there are businesses that are not great businesses. They do like 5% return on capital, and all of a sudden their cost of capital is 7 or 8%. So they're borrowing for 8% and they're earning 5%. They're backwards. And
it's not impossible though that rates come down,
right? And all of a
because
sudden
the market's scared, but
Yeah.
also liquidity for these companies doesn't reappear magically.
So, Dan, I want to get your take on liquidity and like people. I'm sure there's a ton of retail traders that got run over in the last couple of days trying to be cute and catching bottoms and whatever.
Yeah.
So I know you paid a lot of attention to this stuff. So I want your thoughts on this.
What, like in the TBT, like being short the 30-year bond?
No, I'm talking about like regionals specifically. But we could talk. I'm going to through the lens of regionals, but just bigger picture. What are your thoughts on this type of dynamic? So this is from JP Morgan's financial trader Barry. I don't know who that is. Zero Hedge was tweeting this. Quote, we are continuing to see supply in regional banks, and while some long-only sellers are starting to cancel orders and go OTD, what does OTD stand for?
Zero data expiry.
Oh, zero. Okay. The sell skew is too dominant to prevent some trading halts due to volatility. Some investors are more worried about owning a stock that eventually goes into receivership and not selling it, as opposed to beating a rival price VWAP or whatever trading metric is usually used. Those are out the window. We have started to see some buying on the margin, but supply continues to overwhelm demand on our desk. And when they say supply buying on the margin, they're talking about the regional banks.
Right.
So just this idea of like buyers and sellers and duking it out, like how do you think about
who is selling? Or like First Republic.
So how do you think about all
Who's
this?
selling all that stock? Like, forget about there's no buyers. Who
That's
are
a good
they?
point.
I'm trying to think of like who is blowing this stock out? It's the founding family that owns 30% from 1910, or like bank ETFs. Like, who is selling this shit?
Well, one is bank ETFs. I mean, you have a lot of portfolio's, particularly on the big banks platforms. They have these kind of like factor rotation portfolios that have gotten pretty big. And I think there's a fundamental and a technical angle here. So the fundamental angle is, I think the concern about whether or not the equities of these companies are impaired, I think that's much higher than any fear about there being a risk with the bank in the way we just saw with SVB. I think, right? So a lot of these guys are looking at it and saying, okay, for example,
you're saying the bank accounts are okay, the stock price is not.
The bank's ability to make money.
The company is not.
Permanently impaired.
The NIM, the net interest margin, and the EPS, earnings per share, are both potentially impaired for a large number of small and mid-sized banks.
Depositors aren't coming back.
It's going to be, well, you're going to have to incent them, right? And the issue right now with everything in the market is, I don't know where the 2 years today, but 4 or 5% for zero risk.
Yeah.
Not a little, zero.
That hurdle is insurmountable for certain situations.
But okay, local bank of, not Cleveland.
Hawaii.
Pick one. Yeah, actually, the Hawaii bank is, a friend of mine thinks it's really good.
Solid.
A friend of mine actually likes the Hawaii bank.
Pull the trigger on that while he's talking.
I don't know anything about it, but
I
Kansas.
accidentally typed up, somebody was talking about the Federal Home Loan Bank of San Francisco.
Yeah.
And I was looking for like the bonds, and I got the equity, FHLB. It turns out there's a bank called Friendly Hills Bank Corp. This is exactly what you're talking about. It trades by appointment. Like, there's no volume.
Well, okay, but here's the issue, right? If you're a small bank, right, and all of a sudden in order for you to get more deposits, you got to offer like 6, 7%, I don't know, 8%.
Good luck doing that.
Well, then at the same time, you have to go, when you lend money in your community, you got to charge significantly over that because you got to make more than that, and you got to factor in losses.
So that kills the economy.
Well, if this became a system-wide issue, it could be a problem. Now, this is
the
still
borrowers have to pay 11%. They're not going to do that.
Right, that's the one thing I think about. Now, we're not seeing it in any of the data. I don't think there's any reason to think that's going to happen currently. But like that would be the actual bear case. It's not like 08 where like there's a potential for the entire system to explode. The real scary thing would be if just like credit access everywhere shrinks really fast, and it's like way more aggressive than what the Fed's done.
We have to agree, without any data from this week yet, this is a watershed moment for credit availability for the year 2023.
Maybe.
Things are not going to be the same next week as they were a week before this. Or
I feel like maybe it's a contrarian take. Why is there reasonable doubt that this won't happen?
Because I think it really depends like what we're dealing with, and it's not like it was. There were, Silicon Valley is kind of a parody, right? Of like some insane stuff. There's so many good headlines of like,
it's perfectly
smoothie
named.
maker gets funded, right? There's a lot of stuff like that's easy to make fun of, but it's not like it was actually super easy for like most people to get a bank loan, right? Right? And that was one of the things, if you remember back like 2012, 14, 16, one of the things people talked about was the Fed was easing, but they couldn't really get lending going, right?
Because the banks were still gun shy.
Right. And it's not like JP Morgan has like massively expanded their lending to local auto dealerships, right? I don't know how much exposure there really is there. And I think that there's a logical reason to think that could be a concern. But I don't really see how much of a change is happening there. And then at the same time, the weird circular part of this is that all of this fear is causing rates to come in, which is basically easing.
Panic is bullish.
Which is helping the bank's balance sheets.
So I traded Charles Schwab this week, and the 2-year treasury fell 100 basis points in 2 days. And it's like, all right, let's say you were still worried about Schwab's treasury bond portfolio. Probably way less worried given the price improvement that they've seen on that portfolio.
By the way, the 2-year went from 3.7 back up to 4.2. It's madness.
But this is why it's so chaotic, right? Is it's like, okay, so it's all fine. So the bonds sell off again. So it's very, very circular. And just to be candid, you'll notice I'm here today and not on my desk. We're just at very low. We have a relatively large amount of cash relative to what we do normally, because we're getting 4 or 5%, and there's a lot of things we like, and we have the investments we like long term, and we know what prices we want to add things on. But I don't personally, and this is somebody who I am a professional at doing this, I'm not interested in trading these things. This is a knife fight, and there will be some winners and there will be some losers, but I don't think most people listening at home should be playing any of these games.
Can I tell you something? I don't think this is even a great market for pros.
No.
Because the pros all had Silicon Valley Bank at a neutral at worst, but like the bank was fine. 2 days, like it wasn't really fine. There were issues with the duration and all that, but like it's not like a run on the bank was foreseeable. What was foreseeable, the short sellers nailed this thing, by the way. What was foreseeable was that things were getting much worse for this bank with every passing quarter. But I don't even think you could find a short seller who was like, there's about to be a run on this bank. Like,
No.
I don't think anyone was thinking that it would turn this quickly. I give a ton of credit to the people that were short Signature and this, and I don't know how they do it, because staying short these names after they've already fallen 30% and then getting another whoosh lower is like, it's got to be scary to be sitting on a paper profit like that and not take it.
Yeah, I mean, we've had short positions in the past where you have that kind of the Big Short movie moment where the thing is down a lot and you did all this research and it's your moment of victory, right? Wrong. Stocks gets halted, opens up 250% in your face. You get a call, hey, your short's been called away.
Yeah.
That type of stuff happens. I mean, it's really sickening to keep these bets on. And then the other thing, if you have any risk management, is if you work anywhere, like you can't run size in any of these trades. Like even if you were running, and this is kind of my point to my team that we're discussing is, I'm like, are there things we could be punting around and trading? Sure. But there's just no way we could do more than basis points. I mean, 1/4 or 1% maybe on one of these positions. And we're all going to sit around here for 3 weeks just staring at the chart, trying to make 0.05%. When we get 5% on our cash, no, this is insane. This is a really stupid
Right. When
game.
you're getting 5% of your cash, it's not like someone's like, hey, you can make 6% in the stock.
Right.
And you're like, oh, I'm in.
No.
You need so much more than that to justify taking
It's not
risk.
a little bit. Yeah.
That's right.
I'm like, you need to show me like 25, 30% annualized type returns for me to even listen.
Also, if you're short a bank that gets cut in half, right? $100 a share to 50.
Right.
The percentage of that position in your portfolio grows commensurately with that gain. So then it's like, well, we should cover some because this is now a much bigger position.
Well, if you're using puts.
If you're using puts.
Yeah.
If you're borrowing stock, it's not quite the same dynamic.
Yeah.
Okay.
Well, so the thing is, if you're using puts, the position gets bigger as it goes down.
Right.
Because you're basically long the short is the way you think about it. If you're using a short position, like you're probably not, I mean, most hedge funds are not shorting.
How much equity would like a hedge fund typically put up against a short?
It's gonna really
like
vary.
An investment short.
Right. But I would say that like anything 4% or larger is extremely rare.
Okay.
And so when I talk to people who trade at home and then they're talking about positions much larger than that, and I think really to go over like 2% of your capital on a short is really, really ballsy. And it needs to be like that's like
why? Because theoretically the downside is unlimited in a short, or is there another reason?
So I don't want to pick on our boy here. So Nick over here wrote a piece this week, and I was arguing with him about it. Not arguing, we were debating, but he was talking about concentration and leverage.
Yeah.
And
shout to Nick.
I said, Nick, leverage and concentration are not the same. And he was like, but they end up being the same.
Okay.
But the key point I'd make about concentration versus leverage is with concentration, there's 2 ways you lose money. You're wrong, or you panic at the wrong moment. You got this big position in Amazon, it sells off, you sell the exact bottom. With leverage, and so that means if your opinion sways, you can lose money, or if you're wrong. With leverage, if other people's opinion sways,
that's enough.
You're done.
Yeah.
And you can lose everything, not just that position.
That's Tesla.
Right? And so the issue with your short, if you're short, especially if you're short illiquid things that are super high vol, where there's weird, I mean, think about how many people are trading this stock. There's a chance that this stuff isn't going to settle right, and then there's just not going to be any shares available for you to be short. And so there's always a chance, like Volkswagen is a very famous one. Sometimes these things go up 150x for no reason before going straight to zero. And you could theoretically have a 1% short end up being a 50% hit to your fund.
Ugh, can you imagine?
I mean, just like,
even if it's something you didn't even have that much conviction on. Right.
You're like, oh, my analyst thinks I'll put like 0.4% on because I like my analyst and he believes in it. And then all of a sudden you're like 10% of my fund is gone.
So how do you think about using puts versus shorting a stock?
Puts are generally,
Well, you have to get the timing right too
well,
on the put.
the issue is the puts are generally way too expensive. What some people can do is you can actually, and you also have to, until recently, and this has been a big change for long short hedge funds in the last year. For a long time, really till 2008, you were getting paid to short because you were getting cash back and then you got interest on that cash. And then for a long time, you didn't get any interest on your cash.
Hedge fund managers used as not as an excuse, a legitimate excuse as why it was harder to make money that way.
I mean, it was you had one fewer source of income.
Right.
One of your side hustles didn't work anymore.
Yeah.
And now all of a sudden, so if we have cash, what I would call long cash, if you just have cash in your portfolio, you're getting 4 or 5%, whatever money market is. But if you short a stock and the cash you get from shorting it, you're not getting the full money market rate, but you're still getting like 4%.
Okay.
Right? So you've got 4% in your favor. And a year ago, you were actually paying borrow to short things, especially these high borrow stock, these like meme stocks. At certain points, you were paying like a 60% loan shark money type rate. And that means even if the stock isn't working in your favor as a short, you're paying 60%.
That was one of
Griffin?
Robinhood stock loan.
Right.
Like that's a business.
Yeah.
That's business.
And so now it's kind of reversing. But the other thing you can do, back when that was happening, when you're having to pay really high rates to be short, you might actually go short a put against your short. And it kind of takes you out at a certain point, but it just covers the vig you're paying to be short the stock. So if you were going to cover a stock, let's say
Why wouldn't you just own less puts?
Well, you would be short the stock and short the puts. And so the idea is basically, let's say a stock's at $50, and let's say we'd cover the short at 25. And you go, okay, if we sell a put at 25, meaning it takes us out automatically there essentially, well, we get, I don't know, making up a number, $2. All right, well, that's 4% yield on a $50 stock. That's pretty good.
Right.
And you can roll that. And it's the same way people sell covered calls. It's the same thing, but way riskier.
Dan, so shorting is something that there's not like formalized education in that. You learn it from being at a long short fund. So many more people start their career on Wall Street in traditional asset management, where shorting is just not part of the curriculum of the things that you witness in your day-to-day.
Yep.
So it's like a specialized group of people who have a specialized level of experience, for the most part, that know how the mechanics of this work, know like where the pitfalls are, know where those extra profit centers are, et cetera. This is not something that most professionals should be doing, let alone—
these are professional psychos.
Let alone retail. Like these are some of these people that have made money consistently shorting stocks are like elite.
Would you say they're like the Navy SEAL of Wall Street? Would you say that?
No, I have too many friends. I can't gas them up like that. They would never.
No, but you have to be really fucking sophisticated to do this over multiple market cycles.
Well, I would say a few things. Like one, yes, there's a lot of ways this can go wrong. Even the best of the best who've done it for a long time get hammered. The absolute returns you make shorting full cycle tend to be rough. Like it doesn't really make a ton of sense as a standalone product or a standalone strategy. And then the other thing that I think doesn't get brought up enough is that the psychological toll of doing it. If you think investing long is hard, it rips you apart. And a lot of—
It makes you like root against things going well generally a little bit, right?
I would say it a different way. You have people sometimes who buy a stock, and you'll see them on Twitter and other places, and they will believe that there's like a conspiracy against their stock for whatever reason.
Okay.
Now, when you're short a stock, there actually is a conspiracy.
Yeah.
Every single person at that company
wants it to go up,
is working to beat you.
Yeah.
And all of their business partners, when you short a stock, there is actually a group of people who are working together to beat you. You know that going in. And the system also, you're also betting overall that the system's not going to take things higher, which it will. And so there's a lot of things against you. And also, like, this is the other thing that's kind of dark about it is if you get, let's say you actually stumble upon like a real fraud, like really bad guys. A lot of these guys just get away with it. I used to like spend a lot of time looking at like these like exciting things because I think when I was younger I was like, oh, it'll be like these books I read and they're
like
all
a
these
mystery,
crazy. Right? And it seems cool, and especially, man, when you find something and you're like, I sleuthed this out, it feels awesome, and then they never go down, and you pay a lot of interest on your short, And it's just an agonizing, stressful process. And in the meantime, you didn't just buy Google for the last 20 years.
Right, which
Right?
you also would have made money on.
And
Yeah.
you just go insane. And so, like,
Do you think? I think
need
Tesla did that too.
Right.
Like probably 500,000 people.
It's a psychological black hole.
Like he got away. Like he did a lot of things that most company CEOs wouldn't even have
It shouldn't have worked.
the guts to have done.
Right.
And like one after another, things like fell his way.
Pulled it off.
And then he got so big that sure, I'll pay the fine. I don't give a shit.
I don't know if there's anyone on the planet with bigger balls than Elon Musk.
Yeah.
I mean, that guy played like a Game of Thrones winner die style game, and thus far he's won. And and so I just think that there are certain games in the market that you can play. Short selling is one of them. Messing around with these bank stocks intraday during a crisis is another one. It's not you're taking a lot of risk with your money, and that's a really serious thing to understand. But more importantly,
you
you're
should know
taking
what you're doing. Before you play that.
even before thinking about whether or not you know what you're doing, you're taking real risk with your mental health.
Yeah.
And I've seen serious pros have to like go literally live in the mountains alone because they're like broken spiritually, psychologically, and physically from doing this. You see guys get into short selling and or get into like not short selling, get into a specific short, and then you see them 2 months later and they've put on 30 pounds and they've been chain smoking, and I mean it breaks people.
Right.
It's a very special type of person that can do it for a long time.
Yeah, I agree. These people should be saluted just in terms of like what they have to endure. They go up against bad people. There are elements of the government that want them to lose money. Like there's a lot going on there. So
it's
I have a
incredibly
question.
difficult.
Do people ever short a company that they like, or is it usually emotional, like they don't like the company?
I would say that the probability, with a few very notable exceptions, the probability that you survive for a long time as a short seller, if you only short things you dislike, is about zero. There's like maybe like 10 or 15 people that's all they do is short like bad people, but it's way, way harder. Most short sellers, they're not like we short stocks, right? But we don't short stocks because I think the company is a fraud, or I think it's a zero, or I think the people are bad people. I might short a stock because there's two companies in industry. They're both killing it. The last quarter, this one company had like an awesome report, but for some weird reason, their margins were like twice what they're going to be normally. And then the other company had bad margins that quarter.
And they're going to catch up.
And so over the next year,
Yeah.
they're going to reverse. And then people got really, really gassed up on one company. And so a lot of the companies that we short, we've been long other times. We'll go, okay, for the next year or two, it's been so good. Like there were a lot of things after COVID where it was so awesome. Everything was great for them. And we were long them for years. And then by like the end of 2020 or 2021, we're like, this is the top for sales, the top for margins, everything. And it's going to take 2 or 3 years for this to kind of work through. And it was also trading at like 50 times earnings or something.
Like live entertainment?
All sorts of stuff, right? And so like, and then the reason you're shorting it, right, is not even necessarily for us. We'd obviously like to make money on the shorts, but part of why it is you're basically borrowing money against that stock to buy another stock.
Yeah.
Right. And so if I think, okay, there's no way this stock can do amazingly next year, but this one can, I can borrow against one and use it to fund the other. But it's not because like I think the company's going to fail or anything like that.
That's a different category.
Some of the best shorts actually are just stocks that you think can't go up much. You don't even necessarily think they're going to go down.
Right.
Sometimes you find stocks where you're like, I don't really think this is going to go up or down like more than 10 or 15%, but I can borrow against it and buy other stocks.
So I want to talk about stocks that have gotten hammered recently and get your take on this. So year to date, these are winners. I'm talking about the reopening stocks. We're talking about cruises, hotels, airlines, casinos. They've all been
experienced stocks.
They've been monsters this year. So year to date, we're up 12, up 30, up 10, up 20, blah, 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 blah. Okay. Over the last 5 days, however, they've gotten pummeled. So my question to you, Dan, is this a read-through to the consumer finally being at the end of the rope? Or perhaps are these stocks just pulling back after a monster run?
No, this is almost entirely basically not hedge fund positioning, but it's positioning. It's way too soon. We talked about earlier about like potential concerns about credit and all these other things. It's just way too soon to see any of that filter through to actual consumer behavior. If you look at like the casinos,
but I'm asking, the stock's getting ahead of it, or you're saying it's something else entirely?
Well, I would say with particularly the casino stocks, because I cover those pretty closely, they have predicted like, I don't know, 12 of the last 5 or 12 of the last
they trade
1
on
earnings.
China. It's like a whole.
Yeah.
It's a whole different thing.
It's going back to like this is just basically positioning and opinion and people being like, how do I? And a lot of it's now like people selling or shorting because they're like, what are other people going to think will lead? So it's like what you just said, but it starts to loop on itself.
Let's use here's United Airlines.
Right.
Okay. The last 6 months, United is up 20%. I assume inclusive of this. In the last 5 days, it's down 15%.
Yeah, but like,
Right.
look,
and they had a profit warning.
But so look at United, and they all look like this. It was just after the bank thing, it was just a waterfall.
Yeah.
Right.
Well, United specifically though warned on earnings.
But they all look like this.
But yeah.
But the other thing, you know, for a lot of people, the way they structure their portfolios is based on volatility as the way they measure risk. And so when volatility goes up or implied volatility goes up, which just happened, what are you doing?
Are you fluffing you're fluffing it?
I think he's going to take it off.
I'm taking it off.
Are you braiding it?
I'm getting a headache.
When volatility goes up, it causes
Oh,
net.
you know who you look like now?
Me?
Like, not to brag.
Oh.
This is a good thing. Paul Schaefer?
Yeah,
Yeah.
yeah.
Look
Thank
like Schaefer. Was that Letterman?
I can see it.
Yeah,
You got
just
it?
like him.
Yeah.
Yeah.
I mean, listen,
Just like him. Relax.
we,
okay.
we all look alike.
Yeah.
All right.
The volatility causes people to take positioning off, and I think it's very illiquid. So a very small amount of buying and selling can move these things. Then it's a little bit self-fulfilling. And honestly, like who has the guts to step in and be like, no, I want to put a line in the sand and buy a ton of Delta Airlines right now. Not specific to Delta, but just, you know.
Here's the next big catalyst.
By the way, HOD close. No big deal.
No big deal. Next big catalyst. FOMC next week. We already have CPI. CPI came in okay. No problem. Some of the strategists have used this week as an opportunity to rethink how many more hikes they think are left. I think Goldman said probably none now. That's where I am. I mean, what the hell do I know? I don't think there should be more. Again, what the hell do I know? Here's Bank of America making the case for 3 more hikes. This is Ethan Harris. A number of press reports have pointed out that the drop in 2-year Treasury yields in the last few days was the biggest since the stock market crash of 1987. It's also considerably bigger than the drop in yields around the Lehman bankruptcy. I wasn't really aware that we had a bigger drop than back then. He says, here we draw 2 lessons. We got this up. The market response seems way overdone relative to the financial event. And then 2, the Fed is not done hiking rates. The similarities to 1987, basically there was like a pause in the rate hike cycle, and then it resumed right back up again. It's not clear to me what the stock market would even like at this point, because I could see both narratives. The Fed pauses and does nothing after people are expecting 50 basis points as recently as a week ago. The narrative is either the Fed's done, game on,
Right.
or, oh shit, they know something we don't know. Things are...
Yeah.
I don't know which will win in the real markets and which will win on finance Twitter.
Right.
But I could picture... Couldn't you picture both versions of that?
Yes. I think they're going 25.
I think you want to bearishly buy on that news, right? Is that the only way to do it?
Can you
or bullishly sell? Yeah.
Yeah.
I think you want to bullishly take profits with I don't really know what the response would be I'm pretty sure I know what the bond market response would be. Probably more of what we're already seeing, but maybe muted. Stocks, I don't know, Dow up 1,000.
Wait, if what?
Or Dow down
If what?
1,000.
If what?
If nothing, no hikes.
So if they pause, I think you're overthinking it to think that like people will be scared. What do they know that we don't? I think if they pause, the Dow's up 1,000.
Yeah.
But if
What,
it's
is that
down,
what you think too?
If it's down 1,000, would I be shocked? Of course not. What do you think?
What do you think?
I don't think they're going to pause. I mean, I'm not betting on any of this.
I get it.
My opinion is I don't think they're going to pause. But if they did, I think we'd rally. I think we'd probably rally regardless because it's just uncertainty out of the way.
Well, how about this? What about positioning? You like to talk about positioning.
I just have no idea. The thing is, positioning data from yesterday means very little.
Fair. But
Right.
this is
Yeah,
long.
money
This
is
is long
moving
term.
so fast.
Goldman Sachs prime global long-short ratio fell to a new multi-year low, now at 170.6.
What is this? What is this measuring?
This is longs divided by shorts. I mean, how exposed their hedge funds are, right? Dan, am I stating that properly?
I'm not sure what the specific one is, but that looks about right.
So basically, people have as many shorts to longs as they have in, it has this pretty extreme short positioning.
Or just short relative to long.
Same thing.
All right.
But my point is, the momentum, momentum could feed on itself very, very quickly. I think people are not positioned for a rally. Do you think that's fair to say?
Yeah, people are definitely not generally.
What are these, Mike? What are these tweets? What are these tweets?
I didn't put this in. Dan, did you?
It's zero hedge. I assumed it was you.
No. The next one. The next one.
Okay.
I don't know what it
FRC equals the ultimate contrarian investment right now. Did you put that in?
Oh yeah, that was the point we talked about earlier, where there's just this issue of how do you just you have to justify stuff right now versus what you can get on cash, and then as you go out, you really just need to make sure you're getting paid for the risk you're taking. I don't think we need to go through that particular tweaks. We already talked about that.
So this is interesting from Quintanilla. This is from the JP Morgan desk. The desk is eerily quiet outside of financials. Investors continue to grapple with deteriorating fundamentals. Everyone is bearish and positioned accordingly, making shorts hesitant to press and contrarian bulls hesitant to buy.
My mind is now wrapped in a pretzel. So bullish?
Exactly.
What do you even do? What do you even do with that information? Nothing. Hopefully nothing. Hopefully no one's doing anything. Put this chart up. Stocks in the S&P moving together. This is this
is 5-year rolling though, so it's a bit of a weird time period, but still.
It's a good refresher though. This is exactly what happens when there's tension or fear in the market.
No, but I think no. Forget about this, Josh. We're looking at 5 years. Just if you go from 1995 to today, the slope is upwards. I think this is what a lot of people that are mad about index funds and ETFs are pissed off about.
ETF effect is that it's gradually going higher.
Yeah, is that stocks are moving together, and how else do you explain this?
It depends. Well, it depends how you measure it. It's just changing. I think if you're looking at the way they're calculating this, it's definitely going to look like that. There are still other areas of dispersion, but I think kind of average day trading, there's just, in terms of the number of buys and sells that are determined by passive versus anything else, it's unambiguously a much larger share of the market now. And the way I think about the market, I think this is a little bit hyperbolic, but I think active management is a minority now. And I think that, especially when you have times where things are relatively illiquid, active as an aggregate entity tends to move all at once. Everybody gets scared. And so, there's just this weird dynamic. And I think it's part of why you see a puke. And then when uncertainty goes away, the question is, let's say the Fed does pretty much anything next week. I don't know what exactly they do that makes large pools of discretionary money wake up and go, okay, now it's time to sell, right?
It's not, a large pool doesn't have to do it. It's at the margin.
Right. Yeah. But are the 401k contributions going to adjust themselves?
That's one way.
I've been saying that for 12 years.
That's permanent.
So when things are illiquid and you've already had a vomit, if the selling, you don't need additional selling. If the selling just slows, there is this consistent bid. And if that ever reverses, look out below. But as long as that's continuing.
It never will. It's trillions of dollars. It's coming in regardless of what the Fed does.
And by the way, I hear people in the headphones say, "Oh, just wait for what?" It's not happening. People
401k outlawed by Congress.
People are not going to say, "Hey, you know what? I don't want to retire. I don't want to contribute to my retirement account tomorrow." It's never going to happen.
Well, I think in order for that to happen, things would already have to be so bad that that's a smash glass emergency situation. And I was talking about it with a friend of mine who kind of thinks that eventually the passive move will reverse.
Never.
And the argument I had with him is he said that would happen, and then I think the market could be down 80 or 90%. And I said, no. I think if the market is down 80 or 90%, then that happens.
Right.
That's exactly right.
But
you know when I stop contributing to my retirement account? If a meteor strikes us tomorrow, then I'll hit pause.
But
would you even think about it?
It's every 2 weeks. It's every 2 weeks.
Right.
A certain dollar amount, come hell or high water, is going into IRAs, 401k. It's just going to happen. Mm-hmm. Buybacks are another area where, we now have 10 years worth of data, up markets, down markets, good economy, bad economy.
If you're waiting for that to happen, you're going to wait forever.
Right. You're waiting for buybacks to stop supporting the S&P 500. Are you f***ing crazy? That's look what we've already seen. It didn't happen during COVID.
Right.
You think, what is the reason why all of a sudden that level of support will go away?
Well, I think one of the things is if you look at the last 10 years, every time there's been a freak out in the market,
yeah,
I think what net happens is active management loses more market share to passive because they freak out.
Yes.
They sell the bottom. They make dumb decisions. Or, and this is part of the other issue. Like there are some active managers that are very good where over time they actually do outperform the market and yada, yada, yada. However, if you're a client who is not engaged with markets, you don't really care.
Yeah.
And if you are engaged with markets, the heartburn a lot of them get from watching that guy whip around along the way versus just, okay, all this happened and I still just made a reasonable return on the S&P.
Yeah.
There's still just this natural game theory problem from the customer's perspective of just going to passive. And then the issue is that every time we have one of these big volatility shocks,
you lose 10% of the active crowd.
Right.
To
That's
passive.
true.
And then the second the active is done panicking, the market just starts levitating.
It's
again.
not a coincidence that on the heels of the GFC, Vanguard, BlackRock, and State Street became the number
Right.
1, 2, and 3 asset managers in the world.
Right.
It's not coincidental.
Dan, I want your opinion on this. I forget who told me this. I was in Miami a few weeks ago, and I think I was talking about this with Tom Morgan.
Shout out to Tom.
Tom's the best. So this really hurt my brain, but I want your take on this. Somebody was on, I think it was Bloomberg, talking about the democratization of finance or whatever.
Hate that.
But just this idea that if every American started to invest, let's just say we just said every American gets auto deposits, whatever, that
Start
would
doing active investing?
just into the market.
Okay,
Even if it's
yeah,
S&P 500,
yeah,
just index
yeah.
investing. If every American all of a sudden invested, returns would have to go down because if we're just dividing up the pie, everyone would own a thinner slice of the pie.
Or average
No.
PE multiples would gravitate closer to, 30 than 20.
But so the reason why I found this somewhat compelling, or at least why it hurt my head, is like, all right, well, if there are $225 worth of earnings per share,
Right.
and there are a finite number of shares, the more people that are involved, the less shares I have, or the thinner my slice is relative to the overall pie.
But there
Well, no,
aren't
that
a
is- no,
finite
but no,
number of shares.
No, yeah, that assumes they're issuing new shares every time someone
Not
buys.
everything's
forget
like
about share-
Bitcoin,
forget about-
Michael.
forget about number of
There's
shares.
no finite number.
There is a finite number of earnings. There's a finite level of earnings. So if everybody is in, is this completely?
Why is there a finite level of earnings?
Well, the S&P can only earn what
All
it
right, let me
earns.
help you out. If everybody starts investing, theoretically, everyone has capital, which means they might spend more in the economy, which means
All right.
earnings might be higher.
My I don't know, counterpoint. My point would be we
just
just
re-injured his ankle with this question.
we just ran this experiment. This,
Yeah, we
this
did
was
it.
COVID. We just did this.
It didn't go
Everything
well.
went up.
Yeah.
And here's the reality. Passive has a lot of great things for it. It's a great solution for most people, and it probably provides a better outcome overall. But it also not only doesn't think, it can't think. And we are getting to a point where you are starting to really choke out anyone in the market that's allowed to price. And so you have these things happen where you have what happened last year and the year before, and it's happened as long as markets have existed. Everybody's coming in. Things are trading based on vibes, headlines, whatever.
Memes.
Whatever. It
Yeah.
just flows, and then when you have something that grabs attention on top of positive flows, it can go nuts. But these things become totally dislodged from earnings. And then whenever there's a change in liquidity, you have these crashes. And I think there's a reason the market is kind of this very smooth momentum and then elevator down pattern. We're not seeing, I think the main difference in the last 10 or 20 years is really since like 2002, 2003, you're not seeing these like grinding, chopping extended periods. Really? You're seeing like these
Rally
ramps
crash. Yeah.
right? And I do think there's a question of like, because one of the things that I disagree with some of like the blogs I read is that, a lot of people are using like back to 2008 or back to 2000 or whatever when they make these arguments. And nobody means to make a, improper argument, obviously. But if you go back further than that, like the way prices have moved the last 10 or 15 years is very different than most of history.
But wait, don't you? The crashes that we've seen. So,
Yeah.
COVID, the December 2018, I believe it was.
Right.
Don't you think these crashes would have occurred if it was only active managers?
Oh, it'd probably be worse. My point is not like where we ended up. It's more this like no decline period, and then It's just really just the momentum pattern and then the puke and then the momentum pattern and then the puke. And there's this weird thing of like, it's a game that's being played repeatedly, and whoever wins the last game gets to play the next game, and the losers don't get to play the next game.
But what's driving that game?
I think it's the
Federal Reserve.
Well, I think it's there's several dynamics. It's very complicated. There's a rotation from active to passive. There's a reduction in the diversity of frameworks being used on the active side. You've got Federal Reserve, cost of capital, and generally, like, also the other thing that I think maybe is missed is with rates going to zero and returns getting compressed. Part of returns getting compressed is there isn't enough room for fee. There's not enough room for fees or expenses there on the return. Because if you're making 5%, you can't pay 150 basis points of fees, which means you can't afford to have people checking things or evaluating risk.
Sorry. Where have returns gotten compressed? Because the S&P is up like 13% over the last decade or whatever it is.
Well, I'm talking about in terms of like, let's ignore stocks because stocks are ultimately priced based on opinions and flows, but let's look at maybe fixed income or something where there's actually shorter dated fixed income where you're talking about actually a cash yield, right? We're talking about just cash yield, not prices on opinions. As that yield comes in, you know, if somebody comes to you and says, hey guys, I got a real estate deal for you, you'll make 50% a year. You'd probably say, get out of my office. But if you didn't say that, you'd probably call somebody and say, hey, can you take a look at this and like do some diligence and make sure this is legit? And you're willing to spend some money to make sure this is for real. And you can do that when you're going to make 50%, right? You could do that when you're making 25%. But if you're making 4%, you cannot afford to do diligence.
It's a huge chunk of the return.
Right?
Well, so now that Fed funds are over 400, do we think that we're entering a completely new regime?
Well, that's the thing. If returns in terms of yields blow out, then all of a sudden there are VIGs left for a lot of different types of things to happen.
But it'll manifest itself different. You're not going to get back the second and third tier broker dealers with all the analysts covering all the stocks.
But isn't that good?
You won't get that.
Isn't having interest rates mean something good?
It should. You know, the theory would be that it leads to more intelligent capital allocation. I think that's out the window. I think that's over. But I just think, like, because the issue is yields compressed, capital's gone to very, very large institutions, and then you just have a cost problem. Like, JP Morgan Chase is not lending to like a car dealership in Topeka or something like that. Like, they don't have the willingness, the manpower. It's not worth their time to do
to vet that dealership,
to go vet a pet store in St. Louis.
So this is the this is the worrying thing about regional banks going down.
Yeah, now
they will do that.
Yeah,
it could dial up income inequality and things like that as well. You know, if all of a sudden small local businesses have much harder access to capital, but there's absolutely no impact on larger businesses.
Yeah. The banks will lend to people that don't need to borrow it in the first place freely.
That's rule 101 of lending.
100%.
Lend to people who don't need the money.
Hey, can we talk about Barney Frank?
dude, this is the best thing ever. Oh, Barney Frank.
Oh, let's do this first.
Okay.
I mean, we're...
All right.
Go.
So
No, you go.
So Larry Summers tweeted, SVB committed one of the most elementary errors in banking. Borrowing money
He's so smart, you guys.
Borrowing money in the short term and investing in the long term. When interest rates went up, the assets lost their value and put the institution in a problematic situation. So this got quote tweet dunked into oblivion. I just want to read some of the quote tweets because they were amazing. Somebody said, "Is this a bit?" Somebody goes, "First rule of banking, never do banking." Somebody else wrote, "Former Treasury Secretary learns how bank works." Somebody else wrote, "I have to assume the former Treasury Secretary meant something more nuanced, and it was lost on Twitter because he literally just said that an elementary error in banking is being a bank." All banks borrow short and lend long. That's the model. That's fractional banking. So Larry Summers replied to himself, as one does, and said, responding to some of the comments here, of course banks borrow short and lend long, but properly managed and supervised banks limit duration mismatch between liabilities and assets so they're whatever, it doesn't matter.
Great tweet, sir. Like, why? If you're Larry Summers, what is the upside of? I understand the downside. Somebody gets really pissed off and like physically wants to harm you, and then anything else that could go. What is the upside?
It's just a bit killed me. I was cackling.
No, like the upside is he gets 500 likes. Is that what we're talking about? Is that why this is done? Can anybody fill me in
Maybe
on
he
what
gets endorsements? You know, he can become an influencer.
What, like Gatorade?
I mean, I'm
because he is influential. That's the whole. He doesn't need anything. He was in the White House.
Do you stand with Larry Summers?
As president of Harvard?
As long as I've been aware of Larry Summers, he's a guy. He's like a Kardashian. He's been famous for being famous.
Yeah.
And like I'm
But
aware
also saying-
that he did
also
very
saying
serious
crazy
things in the past.
shit.
Well, yeah, he
It's
just
like a Skip Bayless vibe.
No, he was in the Social Network.
was he? I don't know.
He played a role in Zuckerberg, quote unquote, stealing Facebook
He was the president of
from
Harvard.
Oh, yeah,
the
yeah.
Winklevi.
Yeah, I mean, I don't.
He like
I
mediated
think-
as a student.
I
dispute.
think it is. I think he
Same.
is positively benefited by further attention. I'd put it that way.
All right. Barney Frank says they shot Signature Bank in the head Sunday night
Well, that's a fact.
to send a message about crypto.
They told-
Well, there's going to be a lawsuit about this. It's a fact.
Well, okay. That's my
Let
opinion.
me
it's
set
a
this
fact.
up. Let me set this up. Everybody knows who Barney Frank is. He's one of the more entertaining members of Congress
The
during
most.
during the financial crisis of 08, and Dodd-Frank, the legislation that came out of that, is named for him. I think he's a senator from Massachusetts.
Yes.
Yes? Okay. He's on the board of Signature Bank. Whoops. He gave a really interesting interview to, I think, New York Magazine. And this
Oh, wait,
is...
is this in 2018?
No, it's now. Now the question is, why do they react? Why did the regulators seize Signature Bank on a Sunday night and close it?
But wait, hold on. There's an important point here. Barney Frank rolled back his own regulation.
I think he was involved with loosening it up.
For banks to be like extra heavily regulated, if they had $50 billion in assets, they were considered in that tier. He lobbied for it to go up to 250 when he was at Signature Bank, and they were at $47 billion in assets.
Yeah, of course. All right. Now the question is, why did they react so harshly to what they said was meaning Signature Bank's inability to give them the sufficient data? I believe it was probably to send the message that even though we were doing crypto stuff responsibly, LOL, they don't want banks doing crypto. They denied that is the New York Department of Finance or whatever. They denied that in their statement, but I don't fully believe that. Somebody ought to look and see. I wonder, why are we the first bank to be closed totally without being insolvent? And if so, why? I think the DFS, the state of New York, people should have an answer to that. Hold on, let me just finish this. That's why I speculate that using us as a poster child to, quote, stay away from crypto was the reason. There's an old French expression. They were interested in the 18th century, how strict the discipline was in the British Navy. And in one case, the British Navy executed a guy for this is Barney Frank, for a relatively minor infraction because they were worried about the behavior of all the sailors. And the French said, oh, those peculiar English, they shoot one man to encourage the others. And that phrase, pour encourager les autres, people understand what that means.
That's the only reason why Josh read this. He
And
just
I
wanted
think
to
it's
say that.
probably working. So this is a guy that was a senator and wrote some of the most important financial legislation in American history, has a conspiracy theory that Signature
Is it that
Bank was
far-fetched?
raided and closed
Is it that far-fetched?
over Bitcoin.
Is it that far-fetched? I don't want to say it's a fact. I retract that. But it is of my opinion that
You think it's true?
I do think it's true. I
So
do.
why are there any companies left doing any kind of crypto?
Who? What banks are doing crypto?
Somebody's banking
So-
Coinbase.
okay, JP Morgan.
Somebody's banking Gemini.
JP
somebody's,
Morgan.
I mean,
They're not going to shut down JP Morgan.
but Signature was like teetering.
I think like
and they
20.
could get in there.
I think I saw like 25% of their business was crypto.
Why do New York State authorities want to close a bank, want to hurt crypto badly enough to go shut down an otherwise solvent bank?
The government is not being very crypto friendly right now.
I understand. What if the bank, though, was actually in trouble? Isn't that possible, too?
Yes.
He doesn't seem to want to admit that for reputational reasons.
Yeah, but I would point out we have had some explicit high-profile failures recently, right? And both another bank, FTX, things like that, and we don't know what regulators and cops, let's just say, found there, and so we really
Signature might be dirty.
we don't know, right?
100%.
So
I wouldn't defend it.
And I don't think that I would be shocked if a politician on a board was aware of everything a bank was doing. And so what he's saying may be completely reasonable from his point
But
of
he
view.
just doesn't know what they were really doing.
And
I
they
agree
may
with
have
that.
found some like
Money laundering. Money laundering.
worse.
Or worse.
Yeah. So I mean, we don't know. Like I'm sure there will be enough lawsuits to litigate this.
It's all going to come out.
It's all going to come out.
Whatever that bank was up to, there's a
Right.
reason they were killed.
Right.
And
What if it's just crypto?
I
maybe
don't.
it is.
I think it's
would-
beyond the pale for the government to shut down a crypto institution.
Look, I think them. No, but here's the thing.
No,
I think them doing it. I think if it was just we want to send a message to crypto, them doing it right then is a
Hey, they
ballsy.
denied it had anything to do with crypto. So how does that send a message? They responded.
If anything,
And
it's
they said, no, we didn't
emboldened-
do this because of crypto.
Well, I would challenge anyone to find a crypto true believer who, as a result of them closing signature, is now like, you know what? I'm actually good on crypto.
Yeah.
I'm actually,
Right.
I would, you know what? I thought
but-
crypto was a prudent investment, but after seeing signature be closed by regulators, I decided.
This is crypto people's time to
Right.
shine because crypto is at a 52-week high while legitimate banks are failing.
Is it though?
Bitcoin's like 25,000 right now.
I know you're a huge fan. I know you're a huge crypto fan.
Well, no, it's just like, okay, we have one bank that matter, and we've got some
Dan, let me
non-tier one
answer
banks.
you in the style of a pomp tweet.
Yeah. Okay.
Are you ready?
No.
Not one blockchain requires FDIC insurance. Is that good? That's a good pomp tweet, right?
That is good.
Name one blockchain that requires FDIC.
And is that a fact? I think it's a fact.
Yeah. Shout out to Pomp.
Where are we going next?
We were gonna do this Dalio thing. It's too long. TLDR. He's potentially bearish. Did you have fun on the show today, my friend?
Well,
We learned so much today.
I bearishly got bullish. No, bearishly
Did you
got
bearishly get bullish? Okay, I start out the day like that. So, all right, you rocked it today, and we want to wish you all the best with your longs, your shorts.
Your
it
legs.
seems like you're having fun.
Yeah.
I know you can't talk about anything you're doing. That's good. Let's not go over any lines, but it seems like you're in a good place.
everything's gonna be fine.
Look at you.
It always is.
Look at you. Said the non-Silicon Valley Bank customer. Said the non-signature
I didn't
bank
say
customer.
that.
All right. Let's do favorites, and then I think we're gonna go to the Pebble Bar. You down?
Are you coming?
Sounds good.
Are you in?
Yeah.
All
All
right.
right.
he's in.
I'll start. I love 90s movies. There, I said it.
That's really a bold
No,
take.
wait, no, and there's
What about
more.
90s
There's more.
hip-hop,
There's
though?
more. So on the way home, yes, I do like that too. On the way home from Chicago, I watched a great Chicagoan movie, The Fugitive. How fucking good is that movie?
Great movie.
Still rocks.
Yeah. So good. I haven't seen it in a while.
It's so rewatchable.
Tommy Lee is really like carries the
Incredible.
movie.
And so does Harrison Ford. It's like a very unusual Harrison Ford role. It's the only role where he's not like a gigantic personality. He's sort of like understated in that. Dr. Richard Kimball. I also, as I mentioned earlier in the show, watched Night Falls on Manhattan. It's on Amazon Prime right now. Gandolfini, Andy Garcia, Richard Dreyfuss.
It's the DA's office.
Yes,
Yeah.
it's like internal affairs, courtroom drama, dirty cops. I love that shit.
Great.
Love it. By the way, Your Honor's pretty good.
Your Honor's
Your
pretty
Honor
good.
season 2, pretty
Yeah,
good.
it came around.
And lastly, Howard Lindsay did a podcast on everything that he missed. It was awesome. He missed
I
like,
gotta check that out.
All the investments he missed out on.
Zynga
Who was the guest on that?
himself.
He just freestyle. I gotta listen to
Zynga,
that.
Twitter. It was great. It was,
So just Howard being self-loathing.
Yeah,
for
it was
an hour?
so good.
That sounds great.
Howard does self-deprecating better than most.
yeah, because it's legit.
And it's funny.
Yeah, it was good.
I listened to the Acquired podcast. Did a whole episode on LVMH.
They're great.
Those guys are great. It was 2 hours, 45 minutes. And basically what they do is they both read the same books. They read like 5 or 6 books on a topic.
Yep.
And they just go in. And it's a fairly unstructured conversation. At the end, there were takeaways, like what could other entrepreneurs learn from this?
Yep.
The Bernard Arnault story is fucking incredible. Like,
I don't know how it's not a movie already.
I don't understand. This would be, if this were a Netflix series.
Who would play him?
Bernard
Jared Leto?
Arnault in
You
the
would never
70s
believe it.
and then the 80s and then the 90s.
Jared Leto.
People don't even understand. He owns. No. I don't think so. I think you want to use the Frenchman from.
Chalamet.
Well, Ocean's 13. The bad guy is a French.
Oh yeah.
What's that guy?
Vincent Cassel.
Cassell. That guy
Wow.
kills. He might
Yeah.
be too old now. So the story of Bernard Arnault, who now controls.
Oh, it's a great call, Duncan. This guy's a great actor.
Yeah,
Yeah.
and he's French. 70% of the luxury market or some
Yep.
crazy number. Basically, he owns everything that's not Gucci, the entirety of.
Right.
So those guys did a great job. I highly recommend everybody check out that episode. The second one is Michael and Ben had Dr. David Kelly from JP Morgan Asset Management on this week. It was their Talk Your Book episode this week. You guys were great. He's amazing. That was like a macro conversation that was like actually worthwhile.
He's amazing.
That guy knows what he's talking about, David Kelly. So check out Animal Spirits from this Monday if you didn't get a chance. Duncan, you listened to that or you just edited it?
I haven't yet.
Okay, check it out. Very, very good. Very good episode. John, you edited it?
Yeah, it was on the back end.
It's like one of the few that you were actually listening to as you were doing it. You were into it?
He was
okay.
great. He was great.
Yeah, I thought it was great. All right, Dan, bring us a favorite.
All right. Well, I got two. You brought up movies. I recently rewatched a movie that I'm going to argue is the greatest movie ever made. It's not the greatest film ever made.
Okay, movie.
I'm not a film
Got
guy.
it. This is going to have Adam Sandler in it?
Face Off.
Face Off is good. I was gonna guess The Rock. I
I've
swear to
only
God.
seen it once.
I think I probably watched it 10 or 15 years ago.
Travolta.
Cage Travolta playing each other.
great.
John
and then
Woo, the director?
Yeah, and then they're playing each other, playing each other, playing each other.
It's a face melter.
It is so insane.
It is.
And every scene, it seems like the writer's room was having like a bit going where they'd write a scene and then they'd bet money on who could top that scene. Every scene throughout the movie.
Okay.
Everyone is trying to one up the last scene.
Wait,
And there's no CGI.
How
It's all
great is
practical effects.
like the jail with like the electric boots or whatever,
Yeah,
like
yeah,
the
yeah.
magnetic boots.
Right.
So Nicolas Cage ripped off Face Off, Con Air, and The Rock in like 36 months.
Yeah. I mean, what a
legend.
yeah, incredible.
And Snake Eyes, which was not as good, but
Yeah.
Did you smile when on the Super Bowl, the T-Mobile commercial with Travolta?
Oh yeah.
Like you haven't seen him do anything for a
Yeah.
while, and then he just like pops up in this random wireless phone
He's like
commercial,
Mr. Cleaned Up and ready to go. Yeah.
but he crushes it.
He-
and it's
he's
like,
a-
oh yeah, I like that
I
guy.
thought he was like auditioning to be Bruce Willis now. I thought that was what was
he's a
happening.
great looking
Yeah.
bald.
So I'd say that'd be my movie. Is
Oh.
just rewatch that. It's incredible.
Speaking of Bruce Willis and John Travolta, I
Yeah.
rewatched Pulp. I've seen that a billion times, but I
Right.
haven't seen it in probably 15 years.
Yeah.
we can't go down a pulp rabbit hole.
No. I will just say one thing.
It's so much.
Aged incredibly,
Right.
but it does feel a little bit old. I mean, it is. It is an old movie.
30 years
Yeah,
old.
it is. It is.
I don't know. I love that movie. But anyway, so my other favorite would be Rick Rubin released his book after a long time, and
Not
the
the
creative-
I own the book. I haven't read it, but I own it.
the creative act. This is investment advice. Instead of like trying to day trade this market or whatever, go read that book. It's an incredible book.
While you day trade.
It's an incredible book on investing. Really anything, any craft you have, it is just packed full of things where you're just like, oh, duh, I should be doing that. It's just a lot of wisdom, really, really insightful stuff, a lot of good process stuff. I think he said he wanted to try to write a timeless book, and it's one of those things you read it through the first time, and you're like, if I read this in 2 years, I'm going to read a different book. It's kind of a mirror, so definitely recommend that one.
Dan McMurtrie, ladies and gentlemen. How about that? All right, so that was the first half.
We're wearing these
And
wigs
we're-
to the bar, right?
I'm not wearing that wig, so there's no way. Do we have anything else to do, or we get out of here?
That's it.
That's it.
Well
Happy
said.
St. Patrick's Day.
Happy
everyone.
St. Patrick's Day. Hey, where can we follow Dan? On Twitter @SuperMugatu?
Yes, sir.
Is anyone telling you to change your handle now that you're like respectable, or
Respectable. He brought us fucking green wigs.
true, you're not respectable?
You brought these.
Michael-
This wasn't my idea.
Michael was just reminding me you're not respectable. All right, Dan is @SuperMugatu on Twitter. Anywhere else? You're not writing, are you? Good.
No.
Keep it all inside.
I don't have time for
That's what
that.
I always say. Bottle it up
Yeah,
until it's too late.
it's Irish tradition.
All right, Dan, we love you. Fan favorite. Thank you so much for coming back. You're the man. Hey, everybody, have a great weekend. Thanks for listening. Like and subscribe. We'll see you next time.